Morning, I'm Darrell Jones, Director of Research at Hedgeye. Welcome to the Macro Show for Monday, April 5th, 2021. Start of a new quarter. Long weekend, so we're well rested. Now we got some time to get into it.
Ready to get after it here. All right, top three things in my notebook this morning. This is what we start with. Every morning we start with Jonesy, obviously, then it's me. Top three things are the top three things in the entire edifice of the process, and then we get into the wood, which I'll show you here momentarily, and also take your questions, which get voted up and down. First, on Asia, just a good session, okay? Now, Europe generally closed here for Easter Monday. That's the way that they do it there, and at the end of the day, Asia didn't close everywhere. So it's interesting and illustrative at the same time to see the Nikkei push higher. You see Singapore higher. Look at Singapore was a stealth signal within the signal. So again, if you don't look at markets fractally, thanks for joining us. Now you will. We look at everything all at the same time. We don't pick and choose. We don't tell markets what to do. We don't talk about whatever CNBC's headline or narrative of the day or the talking point of the day. We focus on all of it. That's how you look at it fractally, and then things start to pop out. Obviously, Singapore up 7.8% in the last month was a good signal, in as much as Germany was, by the way. We're still talking about Asia, but it's the same thing. You had a global equity rally in the face of people having problems with their own stock picking or sector styles or factor exposures in the USA, which we'll get into as well. Point number two is, again, all-time highs is a long time. So you look at it on Thursday, it was an all-time high for the S&P 500, closing at, of course, 4,019. But the VIX dove right towards the low end of the range. So now we're going to probe. We're going to probe. Again, volatility broke a while ago. So at the end of the day, whether it's the VIX with a 17 in front of it, and we have it going towards 16 today, 16.39. For those of you that don't have our risk range product, we also show some of those ranges here with the graphics. But the big one was NASVOL, like NASDAQ volatility, again, fall all the way to a new cycle low, despite all the rancor about interest rates are bad for tech. Well, if you buy them at the wrong price, they are, but at the end of the day, across cycles, they haven't been, and that is back-tested too. So again, keep your eyes on your fries there. Tech back to bullish trend in as much as the NASDAQ is, and it wasn't like as of today. It was before Thursday's move. Indeed, that big Quad 2 day. For those of you that don't know what Quad 2 is when you have the rate of change of both growth and inflation accelerating at the same time, in this case towards the cycle high for Q2. So it's Quad 2 and Q2. And we have the doctor, copper. So in addition to Dr. Kospi, South Korea, which signaled bullish trading trend as well in Asia overnight, you have the copper with a big move. 3.3% now. This morning it was up less than that. Now it's up more. So again, we get what we call consolidation signals. Again, we've been long copper since June of last year. Not since January of this year, June of this year. So again, we get longer at the low end of the range, you sell some on the rallies. This is classic consolidation within the lens of the dollar, which just failed at trend resistance. A lot of people get sucked into the dollar. Don't forget the consensus, if you look at futures and options contracts, currently long the dollar. That's funny. Big time short the yen, which I was buying all day long on Wednesday and Thursday for a trade, not because it's bullish trend. But again, the dollar's bearish trend, the street's long dollars, and they got scared on commodities, just like they got scared on everything else. Don't forget that this year in the USA, despite, again, the S&P is up 7% this year, despite that, people have been scared of high short interest stocks, momentum stocks, tech stocks, rate-sensitive stocks. Again, we don't wake up scared in the morning. I'm Irish. Those are your top three things. Look at this, Jonesy. Look at this book. Now, for you Italians out there, don't get triggered. This was sent to me by a subscriber. I get a lot of books. And thank you for this, James Durkin Jr., for the book, because he's evidently Irish. Only Irish people would read this. But at the end of the day, I'm not immortal, but I'm a competitor. Oh, yeah. And this process is competitive, and it is not going to be hostage to emotion, elitism, anything like that. We don't come in here from upon high and tell the market what to do or tell you what to do. Opinions are largely wrong in this world, especially from the establishment and those that think they're elite. So again, we're not. We're just grinders. We're muckers. We're Jonesy Buds and mucker. And that's what we do every day. We grind through the data. We embrace the uncertainty. We have the humility to know that we don't actually know anything at all until the signals reveal it and the process is embedded therein. So again, let's keep with that. What we do after the top three things, and I give you a little pep talk on the book. I try to read a book every 10 days. So again, as opposed to being an uneducated and unaware person, I'd like to be educated, and maybe I'm unaware, but at least I'm a little bit more educated about what I don't know. Read a book. You might figure out that you don't know a lot at all, right? That's why I do that. S&P 500 risk range is 39.30. So I'll go through this, 39.38. So again, there's downside now because we just went straight up. and the all-time high of 40.37. So when the S&P is indicated higher than that, which it currently is, that would be an all-time high, okay? All-time closing high, right? When it's indicated even higher than that, it's an even better selling opportunity. But it's not a selling opportunity unless you took your baggage, your emotional baggage, and you bought the damn dips, right? Bought the damn dips. 2 weeks ago, I went to 20 longs and 2 shorts in real-time alerts, and the 2 shorts were treasuries and dollars, right? Now I got 9 longs and 5 shorts. And today I might go to 9 by 9 or 8 by 8. I don't know what I'm going to be. It's not a portfolio. It's a signaling tool that you're not going to get from anyone else who knows what they're doing. Okay? So that's what we, so when you combine the weaponry of the macro show with the tools that we have, you can go to war, right? You can go to war with consensus. You can go to war against your own consensus fears. Your emotions are one of the biggest enemies you have, okay? Whether you accept that or not, I'm telling you right now that that is an empirical fact, okay? So at the end of the day, let's just try to, I know some of you are new to this, it's free today, and I'm smiling at you because my loathers are on there, and maybe my lovers and loathers never meet, all right? Until today, for a free day, we get to have them together. All right, Jonesy, you like that, right? Don't you say that about your lovers? Sometimes?
I do sometimes.
Sometimes, so at the end of the day, it is what it is. What else we got going on here? Just looking at the data. Now look at the volume on Friday. It wasn't, or Thursday rather. It wasn't, again, we're going to a holiday weekend, so it was down volume on an up day. So that, again, what I prefer to see, and again, it doesn't matter what I prefer, our model works on a price volume volatility perspective. So for those of you that are still using single factor models or single factor moving monkey models, 50 days, 200 days, that's like dinosaur type stuff for pre-internet. So again, don't do that. Use a 3-factor model, price, volume, and volatility, and focus on the volatility of volatility. So again, if you look at implied vol today, for example, now you see a diving down in implied volatility. So when a price is A at the top end of the range, which I just showed you for the S&P, 4,037, and B, you see implied vol discounts, again, dive towards the lowest that you've seen in a month, that's when you sell some. Don't just sell it all, sell some. Touch your portfolio. Just touch it a little bit. 25 to 50 basis points at a time. 0.25 to 0.5% of your capital. Please put your capital on the board in your box, whatever it is that you're trading, as a percentage of the capital. Don't stare at it in dollars. Those dollars will trigger emotions. And again, your emotions are your enemy. So deal in basis points of capital. Deal with discipline. Deal deliberately. Okay? Touch it the same way. Don't just say, I'm going to sell 100 shares of this. That's stupid, right? Sell 25 basis points, 0.25% of your capital today. If you have 10 positions that are working that way, why not do that? Why not do that? That's how you can raise some money and then buy some back when we correct. Is the market going to correct that? How many times have we had a correction? It was supposed to be the end of the world. It was the end of ZeroEdge.com in terms of any credibility they've had since being bearish. Since, I don't know how long. I mean, you just write bearish shit all the time, right? That's not a process. That's a marketing plan. Yeah. What else we got? Sectors on Friday were good. Our 4 horsemen riding high. Don't forget that for those of you that are, I guess you wouldn't forget because you wouldn't know. Favorite 4 sectors currently in rank order, and that's in terms of signal strength. Number 1 is basic materials as of this morning. The 4 horsemen have been basic materials, financials, industrials, and energy. Okay, so again, I'll just say that basic materials is force ranked as the strongest signal. As of Friday's close, that's of course XLB, as you can see on the board there. Energy had a great day on Friday, so it's not number 1 because it was up a bunch on Friday. And if you bought some when it was down, you were happy. Again, that's one feeling I'm okay with if you're executing on the process. Not whining when it's down. Energy this year, as you can see, is up 33%. Okay, 33. That's awesome. That's fantastic. Okay, if you just buy and hodled it, you'd have a nice. You'd have a nice Hedgeye handle like Jonesy Buds.
No questions at the top of the queue about energy.
No,
because it's been doing well.
Right. When it goes down, so for those of you that want to participate in this, you're going to get a lot of value. Usually the first question in the queue is to be faded because it has a lot to do with what's not working. So the emotional component of that is to be faded. What else already hit on Asia? Nothing really to do. Actually, India corrected pretty significantly. Maybe we get that at the low end of the range. INDA is your ETF. That's one of our favorites. Again, only when it's at the low end of the range. Only when it's at the low end of the range. That's when we buy things. We buy low, we sell high, and we're revolutionaries by doing it that way. Isn't that amazing? Better than chasing, right? Are you a chaser? You chase things in life? Chasing like a something. I don't know. What are you chasing? What are you chasing? I don't know. People chase all the time. Be your own person. Build your own process, right? Do it better. Don't chase. Chase. What else we got going on for you this morning? We got commodities. You get a correction in oil, so don't chase it when it's up, buy it when it's down. Oil volatility, again, unless it changes here, is saying buy oil. But again, low end of the range is closer to 57.5. Top end of the range all the way back at 65, so that's probably where energy will start to break out again. Currently, I have a consolidation signal in energy that actually looks a lot on the oil price that looks a lot more like copper did before it went up. You know how that works? It consolidates and it goes up. Copper, we've already addressed that. Corn last week was beautiful. So again, last week wasn't a down week for commodities broadly. It was a down week specifically for certain things, like it usually is. But lumber was up over 6% last week. Corn was up, on a rope last week. So again, for those of you that are watching March Madness and all that fun stuff, congratulations to all the teams out there. But this is what I do on the weekend. This is what I do. I doodle and I'm data dependent. This is my notebook. Okay. And some people are like, well, why don't you just punch that into a spreadsheet? Well, all these numbers come from a spreadsheet. And we've actually upgraded our team. We've hired a really interesting data scientist who's going to remodel, like we have some awesome models, our quad models and everything else. Quad models, signal models, pod models. And he's going to upgrade that because we had to get data science into, because we constantly want to push our team to be better, right? We don't want to anchor down and be locked into some, we just don't want to do that. We just don't want to do that. We want to get better, right? You always want to get better. You want to learn from your mistakes. You want to improve your process. So the consolidation signals are interesting. Wheat's up. BAL, which is BAL, is cotton. That's up a bunch here, 2% this morning. Even cocoa's up 1.3%. 10-year yield, 172-ish. Immediate term upside. So this is probably, and I'll go through it tomorrow. If you're a Macro Pro subscriber, what I do is I take you through this 100-slide global macro themes deck. So it's got all the data that supports mostly what's coming out of my mouth. Now, when I'm talking about being an immortal Irishman, that's garbage coming out of my mouth. This data is much more important. 10-year yield risk range, I'm going to focus on this tomorrow. If there's one signal to tell me whether or not it's quad 4 or quad 2, it's that. But we don't just do one signal. We do the singularity of the whole process. I just went through a lot of stuff in a short period of time. Some people are like, he talks too fast. You want me to slow it down? No. All right? So again, 1.60 is the risk range to 179. So it is likely, post that jobs report that we got on Friday, there was no market open, thank God for the bond bears. Not bond bears, bond bears. Bond bears like the good jobs reports, right? So again, this is where we think we're going next. So at 179 in the 10-year yield, bond bears, TLT bears like me, you cover some shorts. That's how you use the risk range of the bond yields. All right, you just don't have people talk whimsically or nonsensically about bonds and interest rates now when they had no freaking idea that bond yields were going to break out when we made that call back in November. All right, good spot to take some questions, Jonesy. Oh, Bitcoin still looks good. Ethereum's overbought, though. We were signaling on that. The Maestro MSTR, which I bought a bunch of when it was for sale 2 weeks ago, or in the last week and a half, it's overbought. So, Button, you might have questions on that. I just answered what I did on Thursday. And if they're up again this morning, I'll sell some more of that. And again, I'll buy it back on corrections. Our Bitcoin tracker product has nailed the low end of the range 100% of the time since we introduced the product. That's because it hasn't broken trend. But again, it is what it is. Buy it at the low end of the range. Don't be panic. Don't be emotional.
Yeah, I totally agree. It's been actually the Bitcoin tracker product has been great for me because it gives you these panic moments, right? Bitcoin because of the volatility. So it has 2 or 3 days of red extreme drawdowns, and then that's where you should be buying.
Yeah, I mean,
but if you can wrap a quantitative process around it, you get a little more comfort when you're down there.
Yeah.
So.
Top end of the range, by the way, for Bitcoin is at a higher high, so it looks a lot like the S&P 500. You know what quad Bitcoin loves? Quad 2. You know what quad Bitcoin doesn't love? 4. So again, it's of the many things I will review on the Macro Pro subscription tomorrow. Institutional subscribers will all be on that call as well. It's the most important thing we do every quarter. It's once a quarter. Again, those things together, it's the singularity of the signal. It's never just one thing.
Okay, top question here is from Michael Latham in Zurich, Switzerland.
Nice. Good morning.
There's been a notable divergence between the U.S. 10-year and German 10-year bonds since early March, which gives further credence to U.S. bonds being extremely oversold. Yields don't go up in a straight line after all. Time to fade this overly, well, you've already touched on this, but we can get into why there's this divergence. Time to fade this overly bearish bond sentiment.
I don't know. I wouldn't agree with the question, and it's nice to get it voted up because I'll have some disagreement or critique of that. Directionally, German bond yields have done exactly what the 10-year yield's done since November, and that's the most important point. We're full cycle investors. Now, if you want to look at it, because German bond yields were, basically down. Their German bonds aren't trading yesterday, but the bond yields are down to negative 32 basis points. So maybe that's what Michael's talking about.
Yeah.
We do not anchor, Mike. Is it Michael?
Yep.
Mike, we do not anchor on what, it's called resulting or anchoring. Like terrible hockey coaches. I know one in particular this morning. They just they watch something and they can't see anything else. They're just like, that guy's done, or that guy. It's like they can't figure it out, right? Because they don't have any vision, they don't have any experience, they don't have any process. So when you don't want to be resulting or anchoring on one thing, what you want to see is the developing play. You want to see the potential in players over a longer period of time. Think of their athleticism, their cognitive abilities. Think of that. So when you look at the market, it's the same way as looking at a football training camp, or it's looking at a hockey training camp, or whatever it is. You get to see a lot more about what's going on. So it's really the direction on a trending basis. And again, whether it's for youth development in sports, or it's for phases of economic growth, they develop over periods of time that aren't one thing. Only the weak mind is captured by the one thing. The strong mind, strong process takes a step back and says German bond yields have been going straight up since Keith and the team said that the global yields have bottomed and should start to go up, and that was back in November. So I think German bond yields are going a lot higher from here, and I think 10-year yields are going a lot higher from here as well. Well, not 179, that's the immediate term range, that's the very short term, Michael. And the intermediate term, I've said many times that we're going towards, currently I have it at 193 on an intermediate term duration on the risk range.
Okay. Next two questions are both about the upside downside in the S&P and Russell 2000, which we've also kind of hit on, but I'm going to ask the Russell question. With Russell showing 8% downside, 2% upside in the risk range this morning, how should we be looking at our small cap exposure within the lens of the remaining quad 2 and impending quad 4?
Well, let's look that up. I mean, because again, I think you're resulting a little bit about what's going on today, and that's just after a big move. So if we go, the Russell 2000, if you go back to some of these days, so the Russell 2000, when you should have been buying it, let's just use the 30th of the show that we did, the 30th of March, okay? On the 30th of March, the Russell, it closed the day prior at 2158. You had 8.9% upside. The only reason why you have 8% plus downside is because you went up a lot from that point. You get it, right? So how you think about it's really simple. There's less upside because we just went up, right? Think about it like stairs, right? Now, the stairs move in this case, so it's maybe a bad example. But again, when we go towards the top end of the range, let's say there are three floors. In Thunder Bay, Ontario, that'd be a big building. That's where I'm from. Again, 3 floors. By the time you get to the last 4 steps on the 3rd floor, it's a long way down. If you want to take the window, it's a rougher ride, right? So again, it's just what it is. That's how you think about it, right? What you should really be doing is executing when it's at the low end of the range with a lot of upside. That's where, and again, it's really hard for people because nobody really coached them, right? They get back to like bad coaches. Bad coaches is pretty obvious. It's in their results, right? I mean, so again, if you look at your results, you're going to start to say, hey, wow, these points in time when Keith is really telling us to buy at the low end of the range is really having the vision for the game. It's seeing the intermediate to long term. It's seeing the cycle.
Okay, this is Ken from Canada. Gold peaked in August 2020, about 3 months before the Hedgeye Quad 2 US call in November 2020. If the Hedgeye US outlook is now Quad 4 in Q3, would it not be reasonable to expect gold to do the same and start turning up in advance of Quad 4? Curious for your opinion. Thanks, gents.
Yeah, again, if you want to front run me and do that, you've been getting your teeth kicked in long gold, right? I mean, yeah. I'm again, the signaling process that I have is very accurate on gold. That doesn't mean I'm going to be accurate this time, but I don't know why you would jump outside yourself and say, well, I got to go buy gold over there because eventually we're going to be in Quad 4. If you want to do that, you just have to take on all the risks that you've had, right? In the last 3 months, just were that, again, some people think I'm just doodling, but literally the length of time of that red arrow, gold's down 9.2%, right? Why? I write down every number. I studied every single number, right? So again, at the end of the day, you should study deliberately. So again, when you look at gold, you look at it within the signal. That's the first thing. The first answer to all your questions is my signal is going to give me the best answer I can get. My signal is not going to be trumped by some level of intelligence or some other hockey player's opinion. No, it's going to be mine. That's my opinion. right? My signal is my opinion. And my signal, what's interesting about it is it actually has nothing to do with human beings' opinions or opinions of themselves. It has to do with the gods, the market gods, the fractal gods. It's just math, right? I reduced myself to that a long time ago because I watch many people in this business, really, they have a much larger sense of, oh, what if this happens and that happens? What you're really doing is you're betting on you being smarter than the market or smarter than the signal. I'm definitely not.
Yeah, and I guess what we've seen from a lot of these signals, including gold, is they're all front running the economic data, right?
Yes.
The non-farm payrolls on Friday, which is now yesterday's news, but was an absolute blowout number sequentially versus quote unquote consensus. ISM manufacturing at the end of last week, off the chart, like literally all-time highs in the U.S. And we've been sort of previewing this quarter, we're going to see this kind of blowout economic data. But that's what the market signals have been.
Guys, do you have some of
us.
those charts, some of Jonesy's charts in the stat pack? You got the rate of change on ISM. They're all in the stat pack that we provide. So there they are.
Yeah.
So when I draw a green arrow like that and it's going quite literally vertical, that's prices paid. So when people say, well, I don't see the risk of inflation, who cares what they say about that? Again, it's their opinion. I don't care what certain people think about certain things. They're irrelevant, right? So again, I was just giving a couple more examples. Maybe I'm a little too hooked to one in particular when it comes to hockey this morning. But at the end of the day, it's just funny, right? It's funny. Like if you had an opinion of this or that, and you had an opinion that there's no inflation, it's just funny, right? It's funny because it's stupid, but it's funny in a way that. And here's a real simple one on inflation. Don't have an opinion about it. Just be long it. Because when it's going up, you make money. You don't have to sit there and intellectually go on some kind of a voyage about what it is or is not. It's right there. It's right there on your screen. So again, growth and inflation accelerating at the same time. All those charts are the same thing. They're one and the same thing, which is quad 2. That the singularity, to Jonesy's point, of the economic signal reflects the singularity of the global macro signals, which includes short long-term bonds and short gold in particular.
Yeah, and on the inflation point, we've been highlighting this for the past couple of weeks, but the supply chain is very constrained. And that was one of the most interesting data points from the ISM report. The supplier deliveries, 76.6, which is the highest number since 1975.
Wow.
So you have this supply chain.
Look at this, Jonesy's chart of the day right here.
My chart of the day, there you go. But I just, it's like, you don't see inflation in that.
That's pretty good. Look, Jonesy's got charts. We have upgraded the macro show in so many ways. Again, this goes back to. I have my glasses on. This goes back to the year. Goes back to when
you were born.
When I was born, 1975. In 1975, it all started. Wall Street had to deal with this guy called the Mucker. That's with an M.
Okay.
That's great. Love that chart.
Crazy chart. Okay, we're going to go to Munich. Anna from Munich. This is an asset that I don't think we've talked about in a while. Hello, Coach. Uranium has been ripping over the past three to 4 months. Can we use the XLB signal as a proxy? Are you still bullish trade and trend?
Yeah, I mean, if you want to be bullish, again, it's impossible for me to get right down to radium, uranium, pick it, right? Like we've been bullish on rare earths, REMX, for example, which is ETF on that, going back to June of last year again. So again, we're bullish on all commodities. And I've said this many times, I'll just say it one more time. I'll buy any commodity if it's at the low end of the range, which includes Bitcoin. Any commodity, any asset that ticks with higher volatility, we call it. You want to call it. You don't. If you didn't like that, you're like, well, it's my precious asset. It's like my child. I don't have one yet, but I have. Fine. So get over it. Call it your asset, right? Call it your asset. So we'll buy any of those things. So that's what it is. I don't see any reason to get like. What I meant to say at the beginning of this little bit of a rant is. I hope you can appreciate that I can't signal on 50 different countries, their stock and bond markets, every single currency and every single commodity, in particular uranium. I wouldn't use basic materials as a proxy for it. I would use uranium as a proxy for it. So if I look at URA, I can just do that. It takes, how many seconds did that take me? Now I have an opinion. I don't go ask some dude from Connecticut who's played one game somewhere. Yeah, no, right there. That's the opinion. That's what I got right there. Uranium, awesome.
This is actually an interesting question. I've been thinking about this as well. Frank from Southern California. In the relationship between CPI and the U.S. 10-year yields, is the relationship between CPI and U.S. 10-year yields an accurate method to forecast where yields are going? In 2000, inflation was approximately 3.5%. 10-year yields are at 8%. Can we predict U.S. 10-year yields using inflation? I wasn't thinking about this question exactly, but the first question was about fading, rates going up in the U.S. Like it's done. But I think maybe the reality of all this is what a lot of consensus is missing is how significant this acceleration in inflation and growth could be, in Quad 2.
Yeah, we've only been saying it since November. So again, to the extent that the gains that we've had since November, particularly on the short side of gold and on bond yields, again, we're not going to, if you're new to this today and you want to be the one that calls the top in inflation, well, join us every morning. Yeah. Nobody on Wall Street does that better than I do. I'm not saying I'm God's gift to doing that, but I'm better than the alternative. I'm an immortal Irishman. Come on, No, but again, we focus on this every single day, and the answer isn't some theory about inflation and some equivalent interest rate. It's in the machine. The machine doesn't think about that. The machine being the entire edifice of quantitative predictive tracking algos that are pushing things up or down. Bond yields go up when inflation's going up. That we know. It's the number one back test looking across the intermediate term trend, the 10-year yield. The best back test for that is indeed CPI headline. It's not about some guy opining, writing his doctorate on this, that, or the other about inflation, or saying there's this relative value pair, or at this rate, this is that. That's not the way to do this. You can try it, and then you're going to come back to me in 3 or 4 years having lost a lot of money, and you're going to say, well, yeah, actually, the back test is better. Let me do it this way. So again, that's not how we do it. We do it the way that I just showed you. As long as we get higher highs and higher lows in 10-year yields, the target is higher.
Well, yeah, and what it's telling you is that inflation is going to be higher, right? It's front-running the data we're eventually going to see.
Yeah, the people don't, they won't have the guys, go to slide 15. Our current nowcast, GDP nowcast, and in this case, inflation nowcast, has got a 3 in front of it. Okay? So whether that's 3.16, 3.19, 3.01, there is a large community of Wall Street people, the consensus, that doesn't believe that that's going to have a 3 in front of it, never mind a 2.5. Okay? So again, that's where we're going. The market's been front-running it for a while. No, I don't think it's over, or I would have said so.
Okay, a few questions on this. This is from Bill Pulte, who's a friend of ours, and if you don't follow him on Twitter, he's a great guy to follow. Made a lot of money as a young guy, now gives a lot of it away, which is awesome.
Pulte's probably getting his questions amped up there.
Yeah, but few people have focused in on this. Is there anything to read into the 170% IVOL premium on XLP? I don't know.
I don't know. I mean, it's a big number, right, Bill?
Yeah.
But what do you read into? Like, what do we read into? Like, gaze into my eyes. Like, it's just what the options market did, right? It's just what the price is. There's a whole bunch of crazy shit going on that page. If I got to deal with other crazy shit, Bill. Like, I don't try to. Let's just say it another way. If I thought it was worth my time, like I could make money on it, I would be delving into that. But what am I going to do with that? Nothing. There's nothing to do with that. It's just a big number. Obviously, it's something that catches your attention. But to me, there's nothing to read into that other than what options just priced in, a big implied volatility premium. That means, what does that mean, Bill? That means that a lot of people are betting against consumer staples. Now, I should say I know what, and this is maybe, it's my problem as a human being. Like, the things that are just assumed when something happens there are that hedge funds have been short consumer staples because they worked all the way into the early part of March. Yeah. Then they got squeezed, right? If you're running a hedge fund, let's say at Citadel, a book at Citadel, you're running consumer, all right? You are running neutral. So you know what that means, Bill? Basically, you know what that means because you obviously know how to do this. Bill's a very thoughtful guy, and to Jonesy's point, a very charitable one that the world should be grateful for. What Bill's done for people is phenomenal for a guy that didn't have to do it, obviously. But if you're running a long-short book at a big place, a lot of these places have to be neutral to the market. Right? So if you're long, if you're a consumer staples person and you love Procter & Gamble, by the way, I don't, and you love whatever, just Clorox or something like that. Let's say you own 2 stocks, right? You got 3% positions in both. And then on the other side of it, you have the XLP at 6%. You're neutral. I'm not beta adjusting it, but you're going to get the point, right? You're neutral. You got 6 by 6. Right? You got 2 great stock picks against the index. Now, when the index doesn't work, you keep buying, you keep shorting it. You keep buying protection on the way up. So that's what's happened. But there's nothing to really for me to read into that other than what I know that's what happened. So maybe I should have answered it that way. I don't think it's a read-in. I just think it's what happened. So that's the way that ETFs move after the fact. You see the numbers. Similarly, you can see on the implied volatility discount this morning of Qs. 32% discount. I mean, that's after Qs rip people's face off on Thursday to the upside. Now there's a discount. Discount means that it's complacent and capitulatory. Capitulatory, people are covering their shorts, and complacent meaning, oh, we're going back up for the bulls. Now, if you look at that and you overlay that, Bill, with the futures and options positioning, what's interesting, and it's not shocking, is that Wall Street, and I put 2 green arrows there because it is a bullish data point. It's bullish that NASDAQ had a 17,381 net short contract position. So the street came into last week shorting tech, shorting Qs, right? Because again, if we go through this and we do it again, a different long short book, if I'm Captain Stock Picker and I'm like, okay, well, I like whatever. I like Cisco. I'm long Cisco and I'm long Salesforce.com. Okay, I'm long these three, and on the other side of it, I got Qs. Right? My Qs are here. This is why, and not maybe, Bill's question was brilliant. Now we know, as Paul Harvey would say, the rest of the story. Now we know that every man, woman, and child who's tasked with being neutral is shit scared of shorting stocks, so they all short the same index, right? That's why you see these net short positions in the indexes. It's not just in Qs, it's in Dows or it's in diamonds. Not the diamonds you're talking about with the hands, not that. We're talking about the real stuff. It's in the Russell, it's in the SPY, it's all net short, right? Consensus has been too bearish the whole year long. The whole year. That's been your asset.
Which is why we've seen pretty bad performance from hedge funds this year.
Yeah.
To start the year off.
The average hedge fund's down like something between 3 and 5% at the end of the first quarter for the year. Long short hedge fund, fundamental long short. That's terrible, right?
Yeah. It's a tough start to the year. We're coming in on 9:30, so we're going to wrap it up there. Thanks, everybody, for tuning in. Back at it tomorrow morning again at 9. Thanks.